All right, here to discuss the U.S. economy, the European economy, and much more, Dan Lacalle, Chief Economist at Recession. Dan, good morning. Great to have you here.
Good morning. Thank you for having me.
All right, so that decision by Fed Chair Jay Powell, give me a sense. How did you view it? The fact that they're holding rates steady but saying that rates will stay higher for longer than inflation is more persistent than originally thought just a few months ago. How did you view this commentary? How do you see it impacting the global markets?
I think higher for longer is here to stay. But the Fed is giving messages to the market that indicate that we continue to look at the economy in a way in which they need to be accommodative. So I think that the Fed will keep rate cuts to a bare minimum and focus on liquidity. And that's exactly what Jerome Powell said. He explained that he would slow down the pace of quantitative tightening, which is a big message. It shows that the Fed knows that the economy is slowing down, but inflation remains persistent. Therefore, the market reaction was very logical. Markets are looking at the Treasury. Treasury issuance of new debt is continuing to rise and deficit spending is not under control. And that ultimately means more dovish policies from the Federal Reserve in the future. So I think that what everybody was focusing at the beginning was whether they would talk about any type of rate hikes. No rate hikes whatsoever, very accommodative policy, keeping rate cuts to a bare minimum because inflation is too high. However, remaining very, very dovish because the quantitative tightening process is massively offset by the Treasury issuance. So basically, deficit spending is completely reversing the action of the Federal Reserve. And that means more liquidity, a tremendous amount of new money in the system.
All right, so more liquidity generally seen as good, especially when it comes to investors. I also want to point to some comments from one of your peers, Mohammed Al-Arian. He tweeted last night after the Fed decision saying in part he feared that the Fed may end up too hawkish for the overall economic well-being, given the set of domestic and international structural transitions. Do you agree or disagree with him that the Fed actually may be waiting too long to cut rates?
I would somehow disagree. I think that the Fed is not being hawkish at all. I think that what we are seeing and markets are discounting is that the Fed's action are very focused on keeping liquidity in the system. It's being extremely prudent with quantitative tightening, and its only real action is rates. And that's what is keeping the economy in a certain positive way. I think that there's going to be some type of impact, obviously. There's no way in which you can bring down inflation to 2% from the elevated levels of 2021 without making some adjustments to the real economy and without getting a significant slowdown in lending and in, obviously, the increase in money supply. That is obvious. However, the Fed is being hugely accommodative. It's been very, very open about its support for the banking system through the window channel. And it's also been very, very optimistic about the situation of the economy. Therefore, I think that what it's doing is try to be as prudent as possible, knowing that on the other hand, deficit spending is not going to help in the pace of reducing money supply.
All right. I want to shift our focus over to Europe right now. The ECB largely expected to cut rates in June. You actually put out a note recently saying that, central banks making cuts is a mistake. Do you believe that still applies when it comes to the ECB?
Particularly negative in case of the euro area, because there is a big narrative in the market that is blaming the Eurozone slowdown on rate hikes. However, the Eurozone slowdown has absolutely nothing to do with rate hikes. It has to do with, as you have mentioned in the previous interview, in fact, it has to do with energy policy, it has to do with regulation, it has to do with the farming and agricultural policy that are slowing down the economy. The problem of cutting rates right now is that the ECB takes for granted the strength of the euro. And if they start to cut rates ahead of the Federal Reserve, that is basically giving the world a signal that the euro needs to weaken. And if the euro weakens, the import bill of the eurozone is going to rise, making it even more difficult for the euro area to grow. And a rate cut is not going to make the Germans in particular, or the French companies, or the Spanish businesses take more credit, because a small rate cut is not the driver of credit demand. What makes credit demand interesting or rise is the fact that there is economic and investment opportunities, and those are curbed by regulation and the misguided energy policy of the euro area.
All right, Dan Lacalle saying that the ECB should not cut rates in June. A bit of a contrarian opinion there. Chief economist at Tressis, Guest-Jean, thank you very much. Great to see you.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.